Welcome everybody. Welcome to the 3 core strategies every retiree must use. I'll just bring the camera quickly back over. My name's Russell Markham. I'll just make this a little bit bigger so you can see me. And I'm the Director of Education for VectorVest for Asia Pacific. And it's my pleasure to have you along today. And I can see, wow, we've got lots of people have come in attendance. Maybe you saw us on Facebook, maybe saw some of the ads that we put out on email. Thank you so much for coming along, giving up part of your Saturday. I'll make it well worth your while. All right, so let's jump into it. I'll just turn off my camera here and we can begin. Okay, so I'll just close that here. Okay, so let's get into it for today, 10 o'clock Sydney time equivalent, and off we go. So the key thing behind why we put this webcast together here is we want to be able to give you the tools so you can retire with peace of mind. All right, so you can retire with peace of mind. Just a little bit of a background behind myself. As I noted, my name's Russell Markham, and I've made all the mistakes there are to make with investing. I started off investing when I was about 18, and around about 18 I got the bug, and then 19 I really got into it. And I bought stocks that would go up, and then I lost all my money on them. They'd come crashing back down. I'd give back all my profits and lose some. I bought shares, sold them out too early, and then they rocketed right back up in value. Okay, so a lot of what I'm going to tell you comes from the heart today. I've been there, I've done it. I've been investing now for just on 20 years. Today is about giving back to you, the investor. How can we help you retire with peace of mind, knowing that you can steadily grow your portfolio, generate income, and preserve your capital? And that's what today's all about. So in this webinar today, and I'll cover this shortly, in this webinar today, we're going to show you that you can retire with peace of mind, knowing that you can steadily grow your portfolio to generate income. And this is such an important topic, and unfortunately many people out there just are not ready for retirement. Often retirees are let down by others who don't care about their money as much as you do. So here in slide number 3 I've brought up here, if you Google retirement planning, you see over here a whopping, 284 million results were brought back. So there's a lot of noise out there. It can become overwhelming. My goal today is to cut through all the noise and show you 3 main things that you should be doing. Now, just to set expectation for this webcast up front, I'm going to give you some great information today. So if all you do is take away that great information, great, I'm happy. For those of you at the end of the webcast today that want to explore what we've shown you and take it into a lot more detail, then at the end of the webcast today, I will offer you, for those that want to take it to the next level, I'll offer you some details on an upcoming course that we're offering. Okay, but today there's plenty of great information in this webcast. So to kick things off and to test out our Q&A box here, all right, let's have a look here. What's the hardest part about preparing for retirement or being retired? All right, so if you let me know in the Q&A box there, let me know what is one of the most difficult things, all right, hardest things about preparing for retirement or being retired, all right, from a financial perspective. All right, so I'll just give you a few seconds here to come through. Yeah, a few of you are noting, yeah, it's interesting. The word trust is used twice there on some of the comments coming through. Who can you trust? Yes, there have been some scandals in recent times, as identified by the press with the Royal Commission and a few other things taking place here. Yeah, Stephen there notes cash flow. Brett notes stock market crash. John there notes finding a reliable advisor. Yeah, a very good point there. Okay, so very good points, and thank you. I see plenty more coming through, but if I've missed your comment, please excuse me. I'll move on, but thank you for sharing it with us. All right, so I want you to have a retirement that gives you a peace of mind. So I've got a framework I'm going to show you here. So what I mean by this is that you need, firstly, money, of course. You need enough money to do the things that you want to do. You need time. Right, so time to do the things that you want to do. You don't want to be sitting behind your computer worrying about your finances day in and day out. You want confidence. It's a really important one. Confidence that you can handle any situation that the market throws at you. All right, so there it is, confidence. Now, to do that, there are 3 parts of your investing that we need to focus on. The first one there is profit. So in other words, the way that we grow our capital. And that's where we primarily focus on strategies to make money that when the market is going up or down, think of this as building the overall nest egg. All right, and a classic example of that is many of us have held on to shares like Telstra because it pays a good dividend, it pays a franking credit. So we hang on because we want the dividends and the franking credit, but we also need to look at the capital appreciation or depreciation aspect of things. No point hanging on to stocks where you're getting a good dividend, but your capital's being eroded very quickly. All right, that can be a very dangerous strategy in the long run. So we need to provide or focus on providing income. All right, so we need to provide income for ourselves since we're already building a nest egg. We want capital growth, but we also need to get some cash, the all-important cash, so we can spend, all right, in our retirement. So we don't want to always dip into the main account to pay the bills. So if we take a vacation or if we go down to the grocery store, we don't want to be dipping into the capital. We'd rather be spending the premium, the yield coming in, so to speak. And the last piece there is that we want to preserve what we've got. Really important there. So we want to make sure that any loss that we take is minimized and everything that we do has minimal risk, and we know how to protect ourselves. It's really important. All right, so to do this, there are several techniques that retirees must use in their account. I want to lay out a map here today, and I'll give you a shortcut to get there quickly. So when it comes to the profit side of things, the first thing that we need to do is we need to focus on, all right, we're going to look at ETFs and stocks, not just stocks, but also some ETFs. We also want to look at dividends, right? So it's really important. We need to find those high dividend yielding stocks. But as noted earlier, we're not just going to buy dividends for the sake of, or buy into stocks that are paying good dividends for the sake of it. It's also going to meet our capital preservation and appreciation requirements. And then we're going to look for franking credits. Now, I want to say that word too often because we don't want to wear it out. We don't know what's going to happen coming up at the next elections on that. It's a bit of a contentious issue at the moment, but let me tell you this, if franking credits are removed, then it becomes even more important for capital appreciation and dividends going forward. Okay, so there are additional techniques which we can go into in more depth at a later time, as you can see from the diagram, but this course is going to concentrate on just 3 powerful techniques for today, which we will cover in a lot more detail for those of you that want to come along to the more advanced course. All right, so there's stocks and ETFs for capital appreciation as noted, dividends, franking credits, and we're also going to just give you a little bit of a snippet here today on covered calls. Now, if there's nothing that you take away from today's webcast apart from the word covered calls, note it down and Google the word covered calls. Do not let the word options scare you. From a retirement perspective, covered calls, it's a type of option strategy, can be one of your best friends, believe it or not. So a very powerful technique, and unfortunately too many retirees out there do not understand or have never heard of the word covered calls, and sadly the reason being is because unfortunately out there the media seems to associate options with, you know, super high risk. A lot of option trades are risky, but there are plenty of option trades, if done correctly, which are not risky, that can be some of your best earners. Okay, so as I promised you in this webinar, I give you 3 core strategies to help you get the results faster. But if we had to shortcut this, then these are the 3 that I'd focus first on with you. All right, so number 1 there, we need to have a profit plan using stocks to grow our portfolio. All right, so we need a profit plan. We need to look to provide how to generate steady income. All right, so I've noted there dividends, frank credits, covered calls. I have circled this one up here. I'm not teaching this today, but in the more advanced course, we will show you some hedging strategies, which involves some put strategies in combination with calls. This is not an options course, but we do just touch on it briefly because we believe it's so important to know about this. And then lastly, we need to preserve our capital. So we'll focus on a trade everyone can do to protect against big losses, and we'll look at a protective put. So we're just going to touch on it just briefly, but for this webinar today we'll just touch lightly on covered calls. So that's what we're going to have a look at today, so let's get going. So the first thing we need to focus on is using stocks and ETFs to protect our profit and to generate profit in the market, and primarily today we're going to focus on stocks. So today we're going to focus on making money when the market is going up and do it in a way so that we profit nicely in a rising market. It's really important to buy into a rising market. All right, and we're going to look at strategies to minimize our risk. So we need to have the mantra or the theme, invest in safety first. In other words, for our retirement account, we want to look primarily at stock safety, more so than anything else. And while it's fun to hit the big six out of the park or the home run, let's take the baseball analogy. Most home run hitters, I played softball, I think it was like a version of baseball when I was a kid, and most home run hitters strike out more than anything else. I remember myself years ago at a club playing softball and wanting to really smack that ball out of the park, but how many times did it really come off? So we don't want you to strike out, all right, or slog as a batsman and get bowled, right? So the home run or the 6-run hit is enticing to a lot of us, but that's not who we are as investors, right? We don't want to be those high risk type investors. So you can end up trading in a way that is totally different to who you are really, right? Like this picture here, look at the old shark pretending to be a goldfish and vice versa, all right? So if you're not seeing the returns that you want, the answer is not to go faster or take more risk. So you don't want to try to become a day trader or really super short-term type trader to make your money back quickly. So when you teach your children to drive, if they were struggling, you didn't tell them to hit the accelerator, right? You would have told them, hey, slow down. They're struggling, slow down. Let's go a little bit slowly here. So we're going to do the same thing here. It all starts with this quote from our founder, Dr. Bart DeLido here, and he notes, good portfolio management starts with buying the right stocks, and good players are important. Good stocks are important. Then it comes down to good management with good stocks. So just like the rugby side there of 1905, good portfolios, just like good teams, start with the right players, start with the right stocks. So let's do a stock picking exercise here called A or B. Think of me as like the eye doctor for this exercise here. So what I mean by that is, when you get your eyes tested, I wear spectacles. When you get your eyes tested, they say to you, which image looks sharper, A or B? Sometimes it's a bit difficult. Hang on, can you go back? I'll just double check again. But often it's chalk and cheese, right? So the reason we're doing that is because I want you to get good at picking stocks for your portfolio and learn how to identify stocks faster. So here we go. Let's have a look at the first one here. We all know this one, Telstra. Now, this indicator that I'm putting on all these graphs here is the EPS indicator by VectorVest, earnings per share. It's a 12-month leading forecast in earnings, and what you'll see is that you'll see a strong correlation between earnings and a share price. You want to be careful about buying into stocks where the earnings are continuing to decline. So, for example, although we saw a bit of a pop coming back up on Telstra, I had noted at one of my presentations recently at the Australian Shareholders Association in Adelaide, I said I viewed that, in my humble opinion, as a dead cat bounce because I still saw the earnings continuing to decline, and therefore I was not convinced that that turnaround was going to last too much longer. Okay, I can see it. The earnings are falling. So game A or B. There's A. So look at it from a share price perspective and an earnings perspective. Number B. All right, sure, in recent times it's had a bit of a pullback, but look at those earnings over the years. Look at the share price that has resulted because of that over the years. All right, next one. NAB versus LIC, Lifestyle, right? Suncorp here, the earnings there, versus Macquarie Group. See, it's starting to jump out. Woolworths, right? In fairness, Woolworths is now starting to turn its earnings around, but look at that when the earnings were falling away. So Woolworths versus Northern Star Resources. What about Brambles here? Right, see the earnings on Brambles, quite interesting. Versus Magellan Financial. GrainCorp versus CIM. Platinum Asset Management. Look at its earnings compared to, say, Auckland International Airport. All right, you see the correlation starting to take place there. So, what did these stocks have in common? All stocks labeled B passed our safety stock checklist or stock safety checklist. In other words, they did some key things. So what we're looking here is for earning consistency, company size, price behavior, business longevity, dividend history, and debt to equity ratio. These are some of the key things that we're looking for. So if you try to look up a stock and information, there's a ton of information out there. You often just get buried by data. So what we've done here at VectorVest is we've created one single indicator that looks at it all. Here's one called relative safety. Okay, relative safety is key. It looks at consistency, reliability. It wants to find stocks with a long track record of having consistent cash flows. That's reliable. All right, it wants to look at reliable management. It wants to look for companies growing their businesses, growing their earnings year in and year out. So you can see on the different scales. So if you can find stocks, with an RS of 1.1 or higher, it's on a scale of 0 to 2, you're on the right track to finding some really good quality companies. You also want to make sure that the earnings of those companies, as we saw earlier, are rising. So here's an example, one of our favorite searches that we use here in VectorVest in terms of finding some of the big blue chip type stocks. And you can just look at some of the indicators here. Relative value is on a scale of 0 to 2, so the higher above 1, the better. It's looking for good upside potential. Here's your RS indicator, and look at that, plenty of them are at 1.2 or higher. They're not penny stocks, so you can see the way we're screening here. They're not penny stocks, 100,000 trades a day on average, not penny stocks greater than $1. We're not looking for contra ETFs in terms of what we're screening, not equal to, so we're screening out contra ETFs. In this case here, we're not looking for ETFs either. Or should I say market indices. We are looking for ETFs. We're excluding market indices in this particular screen over here. But just have a look out of interest. There's 3 stocks, BHP, CSL, and Santos. And that was run just the other day on the 8th of November. Right, so if I have a quick peek at those ones there, here's BHP. I think we had a look at it. Well, we will have a look at it a bit more later on in the webcast, but there's BHP. Look at those earnings. All right, and that was the one that was found up here based on the screening criteria within search as prudent in our VectorVest system. So there's one we had a quick look at. CSL was the second one on the list. Look at those earnings in recent times. They're really starting to motor up quite nicely. And same with Santos. All right, so in recent times, a real uplift has started to take place recently here. This is having a bit of a breather as the market had a bit of a pullback, but look at those earnings. Those earnings invariably drive a share price. All right, so this is how we do it in terms of some of the portfolios we look to build. So for those of you that want to come along to the more advanced course, we'll show you exactly how we build this one here, the All Ord dividend payers. It will only find stocks in the All Ords index, all right? So it's not going to look for anything else apart from stocks in the All Ords. So a strong financial track record like this is likely to ensure strong dividends continuation. If you think about it, if you're buying stocks like the one we saw before, where the earnings are continually growing, they're more likely to meet or exceed dividend obligations. Makes sense. Companies making more and more money, more likely to be able to afford and or exceed dividend expectations. So you can see for this portfolio here, which finds those types of stocks, it's doing a lot of checks and balances, it's using a lot of risk and money management rules. You can see it's annualized just over 16% a year since 2013. That does not include the franking credits or dividends. So you can throw about another 2 to 3% on top of that. Right, the reason why I haven't included them in the returns is because I'm assuming we're going to spend all of the franking credits and all of the dividends, because at the end of the day we need money in retirement. So we're growing the nest egg and we're providing good yield. So we don't want you to focus, what I mean by that is you don't want to just simply forget about safety. All right, you want to focus on safety. So when you don't focus on safety, it leads to your portfolio turning into a bit of a roller coaster. Instead, when you focus on safety, you get the nice steady climb. This is about profit and growing that nest egg over time. This is not a get rich quick type scheme. Okay, so just the methodologies I'm teaching you here, you'll certainly do well over a longer time period, but this is not a get-rich-quick scheme. Right, the second thing that we'll focus on here is using dividends, franking credits, and covered calls. So there's that word again, covered calls, to provide income in retirement. And this is a way to generate some disposable income to help you do those little things that you want to do in retirement. And to do that, you want to get paid, right? You want to get paid, and one of the benefits in focusing on these really safe stocks is they typically pay a nice dividend to the shareholders. So you want to capitalize on that. And I know everyone knows about dividends, right? But finding the best dividend paying companies for a lot of people isn't the easiest thing to do. For example, a lot of people have held on to Telstra, as I noted earlier, for the dividends and the franking credits. Now, not only has the share price fallen, but so too the dividends. So you have to be selective and clever about the dividend stocks that you're holding on to. So here's the all dividend payers, or should I say, this is the fully franked, in this example, the URS fully franked dividend payers. And in here, what I've done here is I've gone back painstakingly on the portfolio just to audit it. It paid out approximately 91,000 in dividends and a further 37,000 in franking credits. All right, this portfolio is annualized over 25% a year, excluding those franking credits and those dividends. All right, and that's what it's all about. You know, and you ask yourself this question, you know, let's say if you just got half of that, 12% a year plus your franking credits and dividends, would you be happy? All right, I think for a lot of us we would. So here, per our retirement screening criteria, we're looking for dividends too. All right, so here's another search in VectorVest for a bit of fun there, just to show you an example. This can really add up over time when we apply this type of technique. So in this example here, dividend delete, we're looking for dividends of 3% or better. We're looking for VST, value, safety, and timing. So we're looking for those shares with strong fundamentals and technicals behind them. And then we're looking for YSG, dividend yield, dividend safety, dividend growth. So we are making sure that the yield of 3% is backed up by strong growth in those dividend payers, the G part there. So they're going to continue to keep paying those dividends. We want to make sure they've got a safe track record of meeting or exceeding those dividends, and we want to make sure that the yield is holding strong. We've backed it up by saying a minimum of 3%. All right, I won't spoil the fun by running it just yet, but there is one such example how we can screen the entire Australia database for high dividend paying stocks with a good, safe track record behind them. Dividend bargains, fully franked. So in this example here, so what we're doing is we're going through and we're finding some pretty good dividend paying stocks whereby they are fully franked. All right, so fully franked dividend payers here, and you can see in the parameters here, both the interim and the final franking credits are fully franked. So we all own some blue chips, right? But what about earning money to own your stocks, to keep holding on to your shares? Yes, believe it or not, there's another way. Yes, by holding on to your shares, you can earn franking credits and dividends, but there is another way you can get paid as well. So I'm not talking about dividends or franking credits, I'm talking about another type of payment, and it's a premium payment. It's been a very popular strategy with our retirees over the years, and this, believe it or not, is safer. So the strategy is safer than buying a share long. Mathematically, it is safer than buying a share long. And this strategy is called a covered call. So capital appreciation may be your only consideration, but earning a premium is worthwhile along the journey. And here you can earn a premium by holding the given stock. So just in a quick example here, let's say you own your BHP shares, and they're about, what did they close on Friday? 33 I think it was, so just over $33. You can say to the market, look, you can have my BHP shares if they go to, let's say, $40 a share or $35 or $36 a share. You can buy them from me at that price. But in order for me to guarantee that I will offload my BHP shares to you at $35 or $36, for example, then I want $3 or $2 per share. The money that is paid up to you up front through a covered call is money that you keep forever. Nobody can take that money away from you. If you think about it, what's the worst that can happen? Somebody pays you a premium to have the rights to take away your shares at a certain price. What's the worst thing that could happen? Well, you make money and you can just simply go and buy those shares again if you still want them. All right. And I'll dig into it a bit more. So you're getting paid to hold on to your shares. Now, a few of you might be saying, well, I never have any intention ever of giving away those shares. I want to hang on to them forever because I like the dividends and the franking credits. Well, sure. What you could do is you could set a very high price where the share is very unlikely to ever trigger, and you can still get paid. It might not be much, but you can still earn a little bit of money on that. So let me dig in a little bit further to show you. So you can set the strike price well out to where it is. So for example, let's say this share here was $100. You could set it up at $120, and you could say, look, if the share goes to $120, you can have my shares within a certain time period. So in options world, there's a contractual period. It might only be two or 3 months. If the share price never goes to, in this example, 120, you get to keep the options premium. In this particular case, it was $2.10. So $2.10 on a $210 stock, you would keep $2.10. Now think about it. If the share never goes to 120, you get to keep the $2.10. If the share price drops $2.10 during that time period for where we contracted, let's say until that point in time there, well, guess what? You haven't lost any money because you've already got $2.10 paid to you up front. All right, so that is what we call an options cushion in a covered call. It's a very nice strategy whereby you can make some good money on the upside and it protects you on the downside. Now, a lot of investors focus, and that was just a little bit of a teaser on it. At the course, we'll go into a lot more detail, but I just want you to be aware there is another way you can make money on your shares apart from franking credits and dividends. Now, a lot of investors focus solely on capital appreciation, which definitely should be the main source of growing your money, or one of the main sources, right? And I agree. But if you start to collect some nice, safe dividends as well as franking credits, now you're starting to generate some good additional income, right? So there's some dividends and some franking credits. Now, in addition, so in here, you can also throw in options premium into the mix. So you can really crank your earning powers. You can start improving them. So let me give you an example. Here's BHP. So let's pick on BHP again. And what I've done for this example is I've set it for 2018. So for this year. Now, that was the start of the year, and I've done it right until close of business on Thursday, I believe it was, right? So here's BHP. Now, notice down here, GRT. This is another indicator I'm going to introduce you to today. This is earnings growth rate, all right? So it is a 12-month leading forecast on the earnings growth, right? So it's a 12-month leading forecast on the earnings growth, and at that point in time there, we could see it was at 35%. So BHP was looking to grow its earnings, and remember those all important earnings that drive the share price by 35%. That was a 12-month leading forecast. So we're after companies looking to grow their earnings because, as noted before, companies growing their earnings are more likely to exceed or meet their dividends, but also, what are they also likely to do on the share price? Yep, you got it. Grow that share price. So as a retiree or those approaching retirement, you want yield and you want growth. It's not good enough just to have like a Telstra type share where you're getting the yield, because if you're not getting the capital growth, you're getting 6% in one hand, you're losing 20% on the other hand, the net effect is a loss, right? You want growth on one hand, you want capital growth on the other hand. So the net effect is nice and strong. And you can see at that point in time there, the yield was forecast to do about 3.57% at the start of the year. So good yield and good upside growth potential. I'm not saying that BHP's shares were going to go up 35%, certainly not. But it was looking to grow its earnings by 35%, which would translate to some good share price growth potential. So, as it turned out, so there we are. There's the DivX date and the payout dates. Just for those of you to clarify, DivX, you need to own the share before DivX date. Don't buy it on DivX date, because if you buy on DivX date, you won't get the payout. You can buy this before DivX date, and you can sell out a day or two later, and you'll still get the payout even if you didn't still hold the shares, as long as you held it just before DivX date and sold it out a day or two later. All right, so there's your payout, and there's your payout. And as it turned out, I double checked on the ASX just the other day, there were 2 lots of dividends. They added up to $1.59. and then there was a further about 68 cents in franking credits, taking the fully grossed up dividend to just over $2.27 per share for BHP. So let's reflect back on it. The share price was $29.68 as of the start of the year. So $29.68 as of 2 January, right? $29.68. So the dividend payout, as we noted, $2.27 for the year. $2.27 on $29.68. Let's assume we bought 500 shares, just for argument's sake. So let's say we bought 500 shares at the start of the year, about $14,800 odd worth. $2.27 on the $29.68 per share. It would have given you a yield just on the dividends alone of 7.6% on the initial purchase price. Not bad, right? Notice the correlation here between the earnings and the dividends paid, and this is really interesting. See the earnings profile going up. What happens to the dividends? Remember, I noted companies are more likely to meet or exceed dividend obligations if they're making money. If the earnings are moving up, they feel more confident to pay out. And you can see over here the earnings were a bit flat, and then up they start coming, and management starts paying out more in terms of dividends as a result. And what happens to the share price? On average, we start to see the share price coming up. So it's a win-win situation. The reverse will happen on shares where the earnings are falling. You're likely to see the dividends fall, and you're likely to see the share price fall. Not always, but typically. So now, for those of you that want to earn a little bit more, so let's just throw in the covered call example here. Let's assume that at the start of the year you own 500 BHP. So at the start of the year here, we came in, bought 500 at $29.68. So we're very happy at this point in time because we've made $2.27 odd in fully grossed up dividends. All right, but during the year, we were going to take a look into a covered call, for example. So let's take this example here. So at the start of the year, you spent just over $14,840 and bought 500 shares at the start of the year. Then on 23 Feb, there's a reason why I've done this, because this indicator I've put on here is called relative timing. It's our technical short-term price momentum. You start to see there was some downward pressure developing, and then it turned around, share price came up, it softened off again, the share price sort of just went sideways, it went back up, share price starts going back up. During a softer time period here, it's a great time to consider a covered call. So what you could do is you could have gone out on the 23rd of Feb, and you could have sold or taken up 5 covered calls. So what that means is that for each 100 shares you own, you can sell a call contract for somebody to take away your shares at a certain price, and they have to pay you some money. Now, as it turned out in this example here, we could have set the strike price when the share price, where was the share price? $30.68. We set the strike price at 35, and we say to somebody, hey, you can have our shares at 35, provided that they go to $35 in the next 3 months. So if we're here in February, what's that, March, April, May, by the end of May, then it needed to have gone to $35 in order for you to take them away from me. As it turned out, it didn't. Now, in order for that person to have the rights to take away your 500 shares at 35, they had to pay out $125. All right, they had to pay out $125 for those rights. As it turned out, never went to 35 by May. Right, it was well away from it. So you keep the 125. So it's additional income coming in. Let's say it did take place, and you did have to give away your shares at $35. You wouldn't have been overly upset. Why? Because if the share price was $30.68, and you were going to give them away at 35, so what's that? 35 minus 30.68 divided by 30.68, you would have made 14%. You would have locked in 14% profit, plus you would have got an extra $125 in your back pocket. All right, that's why it's a very nice strategy. Why I like the strategy too is that if the share price fell, and you were down, it had fallen $125 worth, you still wouldn't have lost anything because you were given the 125 up front in your pocket. It's yours to keep forever. Okay, so let's say you locked in 125. Now, a few of you might be saying, well, 125 is neither here nor there. Agreed. All right, in that particular example there, the premium wasn't all that great. But as time moves on, here comes a really nice premium. All right, so on 29 June, So what we're going to do is we go back to the market. We can see some pressure developing on the short-term price momentum again. So we go back to the market. We say this time around, okay, you can have the shares again at 35. Now it's a lot closer, 33.91 versus 35. You say you can have them at 35 provided that the share price goes up to $35 in the next 3 months. Now, as it turned out, when we set the expiration date there for the end of September, so it would have been the end of September around about here. Again, it didn't get to the $35. This time round, we picked up $475 in options premium. It's ours to keep. So we made the 125 earlier in the year. We lock in another 475. That's an extra $600 in our back pocket. So let's just reflect back on where we were and what we ultimately could do if we chose. If all we did was just simply buy the shares, right? So we just simply bought the shares. We bought them at the start of the year. So let's just go back to the start of the year where we bought them, 29.68. And if all we did is hang on to them till Thursday last week, so just a trading day ago, we would have made, if I zoom in here, $1,825 in profit. Okay, so that being the $33.33 as of 8 November. So the way I did it is as of 8 November, 33.33 minus the 29.68 multiplied through by the 500 shares that we bought, let's say at the start of the year. Right, so that would have given you 1825 in capital growth. But we don't just simply get the capital growth. We can also get dividends. Now, of course, we're going to get this regardless, but there's a lot of investors out there that don't often look close enough at the type of dividends on offer. So we're smart investors here. We could see at the start of the year, we could see the GRT was 35% for BHP, which told us that it was likely to have a good year in terms of the earnings. We needed to watch the GRT, the RS score as well, the relative safety. We could see all that was starting to stack up. And as it turned out, we did get some good dividends. So we got another $795 in dividends. Right, so that being $1.59 we would have got. So if you check on the ASX website, you'll see the first lot was paid on 27 March, was 70.5852 cents was paid out on 27 March. And then the second lot was paid out. This is the dividend lot, including the franking credit. Second lot was paid out on 25 September of 88.5453 cents. Right, yeah, those two together for the year so far, and that'll be it for the year. It was $1.59 in dividends were paid out. So they're the dividends. Now those dividends came attached with franking credits. So we got the 100% fully franked dividends there. So we got the franking credits. And it equated to just on 68 cents. 68 cents times the 500. There's another $341 in franking credits. Plus, what else did we build in? We also got through our covered calls. Now, the reason why I want to show you this is because for those of you that are concerned about franking credits disappearing potentially, all right, we can start to look at strategies like covered calls. Now, in the United States, for example, there is no such thing as franking credits. So investors in the United States, for example, they rely on dividends, and a lot of US investors also make use of covered calls because, as you can see, covered calls can be a lot more lucrative than franking credits, believe it or not. Okay, so covered calls, and that's why covered calls probably now is going to be a very important strategy going forward if franking credits are reduced or removed. Okay, so really important. So what would you rather have? I mean, it's self-evident, right? But I mean, just to accentuate the point, you know, what would you rather have? Buy a share that doesn't pay out any dividends, let alone franking credits, let alone doing any option type covered call strategies? You could lock in a pretty healthy 1825 on your share. So you spent, what was it, $14,840 odd. You would have got back 1825 on BHP if it wasn't paying any dividends, for example. Yeah, it's not bad. But look at this. It's twice as much, or just on twice as much. You could get the capital appreciation. You can then chase after stocks that are doing the dividends, the franking credits, and taking into account the covered calls. All right, so you can put that all together. And that's what it's all about. So growth only, 1825. Now, if we didn't want to do the covered calls, because a lot of us might say, look, it's interesting to know about, but look, it's just not my cup of tea. Fair enough. But we still then want to go and chase after the good dividend payers attached with full franking credits, or at least close to 100% franking credits. All right. So there comes in a lot more value. We want to chase those dividends and those franking credits. So on this particular slide here, as I've noted in terms of the returns here, so if you just look at capital gains, dividends, and franking credits, right, on your 14,840, you've made just on 7.65% yield, excluding the capital growth. So take away the 1825, 795 plus the 341, right, and divide that through by your initial outlay of 14,840 on the 500 BHP shares. You would have got just on 7.65% yield, and then you throw in your capital growth, 1825 on your 14,840, gives you another 12% on the slide here. So now we're going to go and add in the covered calls as well. Look at those returns there. So, you know, if you take all of this, the capital growth, the dividends, the franking credits, the covered calls, add it all up, divide it through by your initial outlay, I calculate just over 23.9% year to date. That being 3,561 returns on your initial 14,840. Remember the 14,840, that's the 500 BHP shares at the start of the year, multiplied through by, I think it was 29.68, was it, right? So the 29.68 through by the 500. Very good returns, just over 23.9, just under 24% returns in total. Now, if you exclude the capital growth and you just simply calculate your yield return on your dividends, your franking credits, and your covered calls, that's 11.69% returns. Compare that to what you would get in a bank, for example, over 12 months. So for those of you that want to take your learning to the next level, and what we do here is we offer you the Ultimate Retirement Solutions course. Now again, I just need to reiterate, this is not a get-rich-quick scheme. You can make some very good returns, but what we're about is safety, reliability, and consistency in this course. And what we do is we teach 4 modules followed by 5 live webcasts to cement everything in. One of the live webcasts is a bonus options module for retirees. All right, I'm not after the whiz-bang, you know, hitting a home run type option plays. If one of those come off, sure, you could retire very quickly, but if they don't come off and you keep making those mistakes, you can certainly blow your nest egg very quickly. We're not into teaching high risk option strategies. So for the bonus module that we teach on the option side of things, it's going to be options for retirement purposes, very conservative strategies. We'll show you a strategy how you can use options to hedge your portfolio. So if you're going away for a couple of weeks on the road, you're going away on a holiday, you won't come back to any nasty surprises, okay? So there are 4 modules followed by 5 live webcasts, and we'll teach you how you can manage the 3 main retirement portfolios that we have built specifically for this course. Now, I ran the course earlier in the year, I think it was over June and July, and I'll show you some of the testimonials. We had some really good feedback, all right? So we ran the course earlier, and due to popular demand, a lot of people have been asking, can you run it again? Can you bring back this course? Hence why we've squeezed it in for the end of the year. All right, so we're going to show you how to build and manage some of these portfolios. We've got a growth portfolio that concentrates on safe stocks that will focus on capital appreciation. We've got a growth and income portfolio that looks at blue chip dividend growth stocks that will focus on income, dividends, and franking credits. And then we have 1 or 2 other key retirement portfolios we'll show you. Now, our retirement growth portfolio, for example, is annualized, what is it, just over 25% since 2013. And as of check this morning, it's averaging just over 75% of all of its trades are winners. It's doing less than 6 trades a year. I'll give you a little bit of a sneak peek to that shortly. So this Ultimate Retirement Solutions course, it's for those of you approaching retirement, for those of you in retirement. Perhaps you might be several years away from retirement. This course is also good for you because it'll start to set the building blocks in place for some of the key things that you should be considering. Right, so it's important to ensure that you're on the right track, to let you take control and not have to rely on others who often do not care as much for you, for your money, for you or your money. All right, so I keep saying this, and I'll say this again here. It's really important message here. Nobody cares more for your money than you. All right, nobody cares more for your money than you. And the outcome is designed to give you clear investing strategies. All right, so you can look at companies with peace of mind, knowing on average you're buying into some good retirement prospects. All right, we've been doing this at VectorVest here for just on 30 years. So we've been in business just on 30 years. We've been in Australia have just over 11. In the United States, over 30. In Canada, I think it's approaching about 20 years now. So we've been around a long time. So the key question is, a lot of people saying, well, what's the price? What's the price if I was to consider this? A regular price there is $4.95 USD. And what I've got here is I've got a special price. We're going to run that special price right through until next Wednesday, the 14th of November. So we're going to provide an early bird price through until the 14th. Now, the price increases on the 15th, so you've got until the 14th. You can lock it in for $3.95. Now, a few of our existing subscribers, if you've been a VectorVest subscriber, quite a few subscribers who've been with us for 5+ years, for yourselves, we're going to offer that to you at $247.50. We're going to give you a little bit of an extra discount as a loyalty bonus for having been a subscriber for 5+ years. Now, for the elite subscribers, in order to get that price, please do call our toll-free number. We're open till 3 o'clock Sydney time today, so that number being 1-800-303-782. 1-800-303-782. It's on our website too, vectorvest.com.au, but no doubt you've probably memorized that number already. But for those of you that are relatively new to VectorVest, or you've been at VectorVest for less than 5 years, here's the link, vectorvest.com.au/URS. I'll go and have a look at that link shortly to show you for those of you that want to sign up. Now, before you consider doing so, this should hopefully give you some further peace of mind. I provide 100% money back guarantee. All right, so after the course is over, if you've shown you've done the work, now don't worry, we don't set you a whole ton of work. We just want to make sure you've watched the modules and you've done some of the homework. Not a lot of hours in the homework. Then, if you're still unhappy, we'll give you back a refund. And one thing I would say, and I'll say this proudly, nobody asked for a refund at the last course we ran for the Ultimate Retirement Solution. Not one person asked, and we had many people attend that course. All right, so 100% money back guarantee. I hope that gives you good peace of mind. And let me give you a little bit of a snapshot here. Here's that growth portfolio. URS, Ultimate Retirement Solutions, All Ordinaries, Div Payers. Now look, it did have a bit of a pullback. I'm not going to hide from the fact there, the market did, but did we unravel? Did things collapse? You know, did we have sleepless nights trying to repair a bleeding portfolio? No, and look, it's starting to come right back up. You watch, it'll surge right back up again because it's got those powerful earning stocks, those top fundamental and technical stocks behind it, but it's also got some very smart risk and money management rules in play there too. So on this particular one here, you can see there it is, 16% plus. I was having a look just the other day when we were calculating all the divs. It annualizes in terms of fully franked dividends just under 4%, and this does not include those dividends or those franking credits. So if you order before next Wednesday, and for those of you that order, say, before today, what we're going to do is we're going to throw in that bonus module. I'll try to keep it open until next Wednesday. So if you order before next Wednesday, because I want you to get the special price, you will also be invited to the bonus module, right? So that being the bonus webinar on options for retirees. And as I said at the first course that I ran, and I'll say it again on this one because it's really important, I believe just that module alone, that live webinar where we teach it, just that webinar alone is worth the cost of the course. You can go on courses for options for retirement purposes and you can spend thousands of dollars, right? They typically are very expensive, the option courses, right? We're not in the game to try charge you thousands of dollars for the basics on options, right? I want to give you those tools so you can have a peace of mind for your retirement. And it's sad that not many people are taught a lot earlier about strategies like covered calls. All right, so we're going to teach you how to do those. Okay, so I hope that gives you some peace of mind with the money back guarantee. You're going to get a lot of value on the option side of things. Let me open up the link. So if you go to that link there, vectorvest.com.au, don't forget the .au/URS. What I'll do there in the chat box here, if you give me a sec here, I'll put that link in as well. So I'll just make sure that I put it in correctly for you, so you don't have to type it into your browser /URS. vectorvest.com.au/URS. Well, I've just sent it to everybody there. If you click on that link, all right, for those of you that want to sign up, then there it is. It should all be working. And I'll just bring this across. So once you put in that link, it then diverts to this one here. Don't worry about this one here. It's a lot harder to type in. Just use the one I've just sent you. But there it is. So it talks about the ultimate retirement solutions, and you'll see that it's 4 days left until the early bird price finishes. So the price there is $395, and then after next Wednesday, the price goes up to $495. So we do give you a nice early bird rate there. But this is what it's all about. A system that'll assist you to look at steady growth in your portfolios, income, a lot of efforts put into the income side of things, and capital preservation. All right, and then we'll go through that 6-part stock safety checklist that we had earlier that I showed you earlier in the webcast. We'll go into that in a lot of detail. So here are the modules, right? So module 1, the Ultimate Retirement Solutions, and this is when the dates are when they get released. All right, so this is when they get released, and then you've got them, and you can watch them as many times as you want for the next 12 months. So everything that we teach is recorded, including our live Q&A and mastery sessions. Everything is recorded, so for whatever reason you can't make a certain time, don't worry. It's going to be housed there for you. We'll give you special login details to a certain portal where you'll get all the key information at your fingertips, so you can go and watch it as many times as you want. But of course, nothing beats coming live. If you can, come live as well, because you can then get all of it answered as well live at the course. The other thing is, if you can't come live, we give you access to my email address, and you can email through our team and myself all the questions you have, and we'll answer them live on the night. It'll then be recorded, and you can then go and watch the recording. So you're not going to miss out if you can't attend live. All right. So number 1, we look at the ultimate retirement solution. We kick off the key concepts. Then we look at capital appreciation, the all-important generating income. Then we put it all together with some of those key model portfolios you had a little bit of a sneak peek look at. And then we also throw in a bonus options module, and we're going to run that on the 19th of December. All right, so by registering today, you'll get full ultimate retirement workshop. There you'll get the full access to retirement workshop, all 4 pre-recorded modules, plus you'll get the live bonus one as well. You'll get 4 live mastery sessions, and I was having a look at the last course we ran. It averaged about an hour and a half, sometimes well over 2 hours on the mastery sessions, because you had so many great questions. And one promise I give to you at each and every one of the courses I run, I answer every question on VectorVest put to me. All right, I've always done that, and I always will. I'll answer every single question, so don't feel that, oh, it's not worth coming along because I won't get my question answered. Believe you me, I will answer everybody's question. Okay. We'll give you 1 year's access to the VectorVest product. So I'll just give you a bit of a snapshot here to the VectorVest product. Here's VectorVest. So you'll see each day you can log into the system. You get the weekly letters, essays that we write here. So here we were talking about some key things taking place. All right, and you'll also get things like this, for example. So for those of you on the course, here we are, Ultimate Retirement Solutions, fully franked dividend payers. And here's a little bit of a sneak peek as to what's currently being held in that system. And if I scroll across, for example, here, look at those dividend yields. So those dividend yields are sitting there, 3.6, 3.5, 5, 2.7, 2.3. All right, fully franked. All right, so there's a little bit of a sneak peek on one over there at the moment. Okay, so you get access to all that, and you get some additional bonuses there as well. So you can see, and we've had some very kind testimonials. Thank you, Christine and Neil, for providing those testimonials there. Here are 2. So here's one from Christine. She gave me a very nice a note there, so thank you for that. I'd like to thank you sincerely for the Ultimate Retirement Solutions training series. I've attended many wealth creation seminars in my time, and some of them have been extremely useful. However, this is the first course that has given me the confidence to invest in the share market with knowledge that if I follow your strategy, I can most likely outperform the fund managers. VectorVest is incredibly powerful, combining technical and fundamental analysis in a way that I've never seen before. Your Ultimate Retirement Solutions course is essential to get the best out of the software, my ability to select well-performing shares and judge when to enter the market. All right, will help me sleep at night. So that's excellent. Thank you for that, Christine. Very kind of you. And Neil notes here, thanks for a well-presented and informative series of webinars. You cover the information in a level of detail such that on finishing the webinars, unlike some other courses, one is in a position to immediately start using the information. With the test and proven model portfolio supplied and the overnight alerts, finding what to buy, when and when to sell is largely automated. The beauty of this system is that you don't have to be a stock market expert to achieve high returns. Thanks for that, Neil. So, yeah, exactly right. We will give you a system exactly when to buy, what to buy, and when to sell. We give you the tools so you can stress test the very type of strategies you're after. And for those of you that like to cherry pick, for example, you can come to UniSearch. Here's that dividend bargains, for example. Let's run it as of Friday. So this one here is dividend yield of 2% or better. Let's see on this one here, we're taking the 50-day average of at least 25,000 shares on average, fully franked. So you can then run your eye down the list here and go, okay, here are some of the shares that meet that criteria. And if you want, you could come in and tweak it further and say, you know what, I want 3% or better. Make the change, run the search again, and now you start to get some further information. So these are just some of the building blocks behind the system, but in order to start building some of these portfolios, we take a lot of this and we have certain rule sets, all right, because it's not just good enough to buy and hold. We need some strategies, when to buy, what to buy, when to sell. We need risk and money management, right? This is a 10-share portfolio. It's down to 5 currently in the market. So it's shrunk a bit as the market had one of the biggest pullbacks since the GFC, all right? But as the market comes back in, we will filter stocks back in, right? It's automated. You get the alerts. You can set up the alerts. So edit under here, for example, alert settings, and you can then turn on the alerts. Okay, so I'll just give you a bit of a snapshot there, for example. So you get all the alerts sent to you. We have mobile apps. So if you're on an Android or an iPhone, you don't have to worry. You can take VectorVest with you as well. Mastery Q&A, this is where we have the live session. So you can see release on the 19th, you've then got the follow-up on the 22nd. Release on the 26th, you've got the follow-up on the 29th. Release it on the 3rd, we've got the follow-up on the 6th. And released on the 10th, and we've then got the live follow-up. We can ask as many questions as you want on the module on the 13th. And then we've got the basic retiree options module. So what I mean by that is it's options for retirement purposes on Wednesday the 19th of December, and that's at 7:30 p.m. Sydney time equivalent. All right, so that's 7:30 p.m. Sydney time equivalent. Okay, so thanks for all the questions coming in. Let's answer them in here. Excellent. So yeah, a lot of you confirmed that I'm coming through loud and clear. Thanks kindly for that. Let's see. All right. So BHP EPS going up in this time frame yet. Growth rate flat to down. Notes Brett. Look, in the course we'll cover that, Brett. But the key thing is I'm not concerned so much about the profile of the GRT. If GRT is holding steady, I'm still bullish. All right, so if I bring up BHP, so these are some of the things that you'd learn on the course, for example, and this is one of the ones we're running earlier in the course, one of our more technical trading courses. Let's just clean this up for now. I'll take that off for now, and let's put in GRT, add parameter, growth rate. All right, you're still looking to grow your earnings at 20%. Sure, it's come off a bit, but any company looking to grow its earnings by 20% is very, very strong. All right, so we're not concerned as the profile. It's the actual number at the end of the day, 20%. This is the profile that you will be concerned about. You want to make sure that those earnings continue to move up. Okay, so nice earnings moving up, and as we expect with the rising earnings, if I come in and put on the dividends paid, right, so the dividends in dollars and cents, and let's just change the color to differentiate the two, make it stand out a little bit better. All right, here we go. Okay, so there's that correlation. Rising earnings, rising dividends. Now, if you pull this back when the mining boom came to an end, you'll see the opposite took place. Now, BHP did hold quite steady for quite some time in the face of a falling earnings, but eventually those falling earnings will drag those dividends down, and it occurred here. It took place. The rebuild phase is taking place. Here it takes off. Earnings stop picking up. Dividends start following up. Right, so that's why it was a very nice re-entry for a lot of our retirees. Okay, so thanks for that question there. Next one here, Charles asks, is this an Aussie-centric course? Yes. I know there's a US version already, notes Charles. Yes, absolutely. This is Australian-centric. All right. When we come to the options, I might, for those of you that are interested, I might give you a little bit of a sneak peek into the US market, because if you're interested in doing some of the option type strategies in the US, you can't beat the US. Best for liquidity, best for selection. Very good market for options. Tons and tons of optional stocks. In this course, and for those of you that do end up subscribing to VectorVest, we give you access both to the United States and to Australia. Right, so you've got over 10,000 shares you can look at for your retirement purposes each and every day. And yes, I can confirm in your self-managed super fund, you can hold US stocks. Yes, in your retirement fund, you can do US covered calls as well as Australian covered calls. Fully allowable in a self-managed super fund, but please, don't want to be seen to be giving tax advice here. Do double check with your accountant. But I certainly do it in my self-managed super fund, and so do several others that I know, and there is no issue. Okay. Let's see, Alan notes, Russell, need options analyzer for the options, notes Alan. Look, we will touch on it. It's more the theory that I'm going to be teaching at this stage, Alan, so it's not super critical to have the options analyzer. It's more the theory behind it, but certainly for those of you that want to start practicing it, we'll refer you on to some tools that makes it quick and easy. Let's see, Margaret asks, is this for someone who is totally novice in covered calls? Absolutely, Margaret. I mean, everything that I'm going to teach from the option side is from the basics. All right, assuming we have no knowledge up to a level where you can walk away and go, actually, I have a fair idea how I'm going to do this now. By the end of it, I'm going to show you exactly how you can do it. So when I say fair idea, a very good idea as to what you're doing. Okay, let's see. Anthony notes, do you have a version of the US stocks and Hong Kong stocks? Absolutely, Anthony. So we'll give you access to both Australia and to United States. But if you wish, if you wanted a third country, you could certainly purchase a third country. It's $199 US a year for a third country. All right. So 199, what's that? About 230, 240 Australian dollars at the current exchange rate. Was it a bit more? About 260, 270 Aussie dollars for a third country. For most of us, I think 2 is probably enough. But look, all the more power to you if you did want 3. If you just wanted Hong Kong and United States and you didn't want Australia, certainly, then you could keep it within your annual subscription for the 2 countries. So you can change your 2 countries. All right, yes, we do cover Hong Kong. I used to teach Hong Kong several years back. Go and present in Hong Kong, in Kowloon, and in Hong Kong Central, and places around there. So I know the Hong Kong market very well. Very interesting market at the moment. It's under a lot of pressure. A lot heavy sell down going on in China. It's affected Hong Kong. So there could be some explosive rebounding opportunities in the months to follow. Let's see. Kamal asks, what minimum amount of money do you need to start building your share portfolio? What's that, 50,000, 100,000? What was interesting on one of the courses we've just finished, the Wealth Creator course, where we covered the US market as well, we showed one of the worry-free portfolios in the United States. And I took 10,000 US dollars on that portfolio back tested it as of 1996, I think it was, when we kicked it off, to now. And that $10,000 had turned into $65,000. So we did it on as little as $10,000. Now, for retirement purposes, this course is going to assume a bigger portfolio amount. So we're typically looking at $50,000 plus. And the reason being, most of them are $100,000, and then some of the portfolios are $250,000 to $500,000. I'm not saying that you have to put the money in that amount of money, but the reason why there are higher amounts is because we are chasing after the franking credits, the dividends, and some of the option premiums. So the more option contracts we can do, the more premium we can bring in, the more shares we hold, the more dividends we get, the more franking credits we get. It's all relative. At the end of the day, no matter how big or small you're investing, at the end of the day, the ultimate measure is what is your return on capital. All right, so we're aiming to get 10% plus a year in and year out on average. There'll be some years where you don't get that, but on average, that's what you're aiming to get. So for example, if I bring it back into the portfolio here, this div payers, for example, right? It's the US div payers. Now, if I look at the performance here, yes, there's been a bit of a pullback in recent times. Great opportunity now to get in for the rebound. But when I look at this one here, for example, and let's sort it by, here's just a couple of other ones I've got in here, but here we are, URS, for example, this one here that we were looking at, the all div payers, as I noted, 16%, right? 16%, 15% drawdown. That's the most the portfolio ever lost from a peak to trough cycle. That's really impressive, considering that we're holding on a little bit longer to get those franking credits and dividends. So we've kept it pretty low there. This is the fully franked div payers. That's annualized 27. Like I said, divided by 2 to be conservative. Would you be happy with 8% plus your franking credits and dividends taking you out well over 10? This one here, half of that. What's that? That's 13. Throwing your franking credits and dividends takes you up over 15 on average a year. US retirement growth. And now remember that this is right as of Friday, right? So this has been through that recent market pullback, the correction. Retirement growth 25, max drawdown 16. All right, so some pretty impressive ones. And for those of you that want to go on and build some other types of portfolios, you can see you can certainly generate some pretty impressive returns. Okay, so I'll minimize out of there, back there. So there's that link, vectorvest.com.au URS. Let's see, next question here. Hi, Lipang notes, I am following the 10 stock model portfolio. One of the stocks is now a sell, but the stop loss is 15%. Should I follow the sell rec or stick to the 15% stop loss? Look, the key thing there behind the model portfolios, and that is stick to the rules set in the model portfolio. The amount of times I've tried to override some of my back testing or some of the model portfolios and say, you know what, I know I tested those rules extensively, but I'm just going to bend them for the stock, generally comes back to haunt me, right? So, as long as you've back tested whatever strategy you're following, so the 10 stock model portfolio, all right, and I know that was a portfolio I built with the community at large. When was it? Last year, about June, July, on the blog. I put out all the details on the blog behind that 10 stock model portfolio, and we all had a bit of a say, and then ultimately we built it. We were happy then. I believe we're still happy now based on back testing. I would stick with the rules. Just on that, so for those of you that are new to VectorVest and you want a little bit more to find out about VectorVest, let me just quickly do this. I'll bring it across so you can see vectorvest.com.au/blog. Here we go. All right, so here's the homepage, www.vectorvest.com.au. If you want to call our team rather than go through the link, call our team on 1-800-303-702. We're open till 3 o'clock Sydney time this afternoon. You can see over here, look at that, 218 Reader's Choice Awards by Stocks and Commodities magazine. That's a very highly read, reputable magazine. I always view the Reader's Choice Awards as one of the best type of awards because at the end of the day, who's the ultimate judge? It's the end user. In this case, it's the reader, right? There's our number, 1-800-303-702. Give our team a call if you prefer to place your order, if you want to do the order their way or find out a bit more about us. But this is what I want to refer you to, the blog. So if you go to vectorvest.com.au and then click on the blog, or you can just type in vectorvest.com.au/blog. I'll send you that in the link box too, because that's always useful. All right, so send to all. Here we are. Hopefully you've all got that one there. Whoop, I might have sent it incorrectly. Let me just try that again. All right, there we go. That should have gone correctly. Okay. But you see over here, this was advertising what we're doing today, but this will be interesting. Just some of the posts that we put from time to time. We do about 3 or 4 month performers in a down signal. We're seeing that market rebound. You might want to take a little bit of a closer look at this right up here. See the types of stocks that we were talking about. I won't spoil the surprise here. Have a look and watch those high CI prospect stocks. These are pretty explosive stocks. Really important. This is what our retirement course is all about. The role of a stop loss in our portfolios. I wrote this article, part 1 and part 2, for the Australian Shareholders Association, who kindly gave me the opportunity to write in their magazine there. So, really important. A lot of people say to me, Russell, can you tell me what stop loss do I need to use? And the example, the analogy I use these days is it's like asking a racing car driver what type of tires he or she must use at any point in time. Well, it depends. What are the conditions? Is it wet or dry? Are you going off-road? Are you going on tarmac? Are you going on smooth or a smoother type surface? Are you driving in snow? I mean, we don't know, right? So it depends on your type of portfolio, and ultimately, at the end of the day, nothing will beat back testing your portfolio over several years with certain types of stop losses, so you will have a very good idea as to what type of stop loss to use. And over the years in Australia, for example, I have found that a wider ranging stop loss works better on the blue chip prudent type stocks. However, a tighter stop loss on average has worked better on the more speculative type stocks. Not always, because it depends. Is it a 5-share portfolio? Is it a 10-share portfolio? Is it a 20-share portfolio? All of this comes into play, and this is what this course will do. We're going to show you how we stress tested the parameters. All right. So anyway, so you can go through here and check out some of the older posts. I just wanted to show you this. There's plenty on here, plenty in there. In terms of the VectorVest system itself, once you come along to the training, we'll also refer you on to things like the VectorVest University, where again you'll get access to our special presentations, plenty of excellent information in there. We often write up articles specifically for retirees, 5 keys to managing your income trades. That's a great retiree strategy, that one there. Where was the other one? Simple way to understand options. So I take what's covered in here in a lot more detail. Marijuana stocks were going mad in Canada and the US. So, marijuana magic, question mark, got to be careful. Not all of them are magic. Keep your guard up. This is when the market was starting to fall away. Just plenty of good stuff in VectorVest. We pride ourselves on having excellent education resources for you. Okay, just for those of you that were wondering what the question before was being asked on, let me just go to the portfolio, sorry. The gentleman before was asking, there was a question prior to that. Sorry, it was Lip was asking in regards to the 10 stock model portfolio. Do I follow the rule sets? So look at that portfolio. It's a beautiful portfolio. Yeah, it's had a little bit of a pullback, but one hasn't in the recent conditions, but it's a bit of a scratch relative to the entire performance. Do I follow the rule sets or do I override them? There's the rule set, 30% gain, 15% loss. These momentum stocks we have back tested and stress tested. These momentum stocks work best based on that stop criteria, for example. Okay, but I wouldn't say that was a retiree portfolio. That's more of it's moderately aggressive. Okay, so I'll minimize out of here and let's make sure I'm continuing to answer all the questions here. Let's see here. Ken asks, if you own a covered call and the stock tanks, do you still have to hold till the expiration date? No, Ken. You can buy back your buy back your call that you've sold. So you can buy it back. You've sold it to get the premium. You can buy it back. If the share price is falling, the good news is you will buy it back at a cheaper price because it will be worth less. You sold it at a higher price, so you actually make money on the call, but the key question is, was that money that you made in the call enough to offset the loss that you may be experiencing on the stock? We will show you exactly how to manage that to perfection. Okay, Brett also asked briefly, why would someone want to be on the other side of the covered call transaction? Yeah, it's a great question. Again, we'll teach that in the course. A lot of those are institutional buyers. They don't want, it's the old FOMO, fear of missing out. They don't want to miss out if a stock is going to move up nicely in price, but they don't want to commit a lot of capital. So what a lot of institutional type investors, hedge funds, for example, they'll look at BHP at the start of the year and say, oh, growth rate's starting to fire up. It's looking pretty good, but we're not sure just yet. And maybe the senior manager or the partner managing that hedge fund might say, no, I'm not a fan of BHP. We got burnt during the mining downturn, and I'm a little bit disappointed with BHP. But I tell you what, if you're so convinced, Russell, on BHP, what we'll do is you can buy some call contracts. Let's give it a 4-month expiration period. Buy the rights to own them should you choose. We don't have to, so it's just a right, and we'll see how things pan out. So what I do is I come in there and I say, oh, okay, I can get a strike price of $32 or $33 at X dollars and get it signed off, and I'll buy maybe 2,000 or 3,000 contracts, for example. All right, now it gives me the right to own BHP at 32. All right, and let's say BHP goes all the way up to $38 or whatever it might be. I've now got a contract where I have a legal rights to own them at $32 should I choose. I don't have to. All right, so why would someone want to buy in? Because they believe that the share price is going to go up. Why do they believe the share price is going to go up? Key drivers like earnings growth rate profiles, all those key things. All right, so great question. We explore that in more detail. Let's see, Jeff asks, the Ultimate Retirement Solutions calls model portfolios. Have you backtested further back, say picking up the GFC, and if so, what were the performance and drawdowns? Yes, Jeff, we have. But the key thing behind this course is we want to concentrate on what is working right now. And what I mean by that is the last 4 or 5 years, but certainly we can go back to the GFC. We have several portfolios in the system where we have gone back to the GFC. I know the 10 stock model portfolio, for example, I pulled that all the way back to the GFC. There's another one here, for example, that everyone will have access to, and that is the Safe and Sure portfolio. Pull that one back all the way back to the GFC and have a look. It holds up very, very nicely. Okay, so yeah, great question. We can explore that in more detail at the course. But in terms of what's working now over the last 4 or 5 years, that's the main aim behind this course. So the growth portfolio, for example, I'm wanting to explore what is working now. All right, and because we've got good risk and money management rules, we're certainly not going to let it unwind and fall all the way down and give back all of our great returns. Okay. All right, so I'll leave it there, www.vectorvest.com.au/URS. Look, if you've got any more questions, I'll give it a couple more seconds, quickly put them in to me. And I hope look, if I haven't answered anybody's question, just quickly just copy and paste and bang it back to me to make sure I've definitely covered it. But look, I look forward to seeing those of you that are going to come along. I know we had a lot of good feedback on that last course, and we just picked out two examples here. We had about 8 or 9 really good testimonials. So here are 2, for example. Okay, so it looks like the questions come to an end. I look forward to seeing you. So just to go through those dates again, I'll just double check it off my calendar here. The first one that we kick off is the 22nd of November at 7:30 p.m. Sydney time equivalent. Then so that's where we run the mastery session for module number 1. So if you just go back, you've got the dates on the screen. Then we'll have our next live webinar there on the 29th of November, and then on the 6th of December and the 13th of December. And then we'll have the bonus options module on the 19th of December, and you'll get recordings each week sent out to you for the key module. And then you bring all your questions along, come along to the mastery session where we go through it in a lot of detail. Okay, so hope you got a lot of value out of today's session. If all you've taken away today is just some of the key things that I've taught you behind earnings, so if I just quickly go back to some of the key things we covered today, just finding those, those earning stocks. Pick on those stocks that are growing their earnings. And if the only other thing that you took away today is to explore the concept of a covered call for retirement purposes, then I'm really happy, because those are 2 great bits of information that you've taken away. And the other thing, of course, for those of you that are coming along to the course, I'll just quickly jump down to here. Look forward to seeing you. All right, so there we are, 1-800-303-782, and we're open till 3 p.m. Saturday, Sydney time today. Okay, thanks again. Have a great weekend, and thanks for giving up part of your Saturday morning. I hope you got a lot out of it. All right, I look forward to seeing those of you who have signed up for the course. Thanks again. Have a great weekend, and bye for now.